Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about John Wiley Sons Inc. quarterly report. John Wiley Sons Inc. offers a wide range of businesses and services to advance science, innovation, and learning globally. The company's research segment provides scientific journals, related content, and services across various fields such as physical sciences, engineering, health sciences, social sciences, humanities, and life sciences. The learning segment is another key area where the company excels. It offers print and digital books, digital courseware, and assessment services for businesses and professionals in categories like business and leadership, technology, behavioral health, engineering/architecture, science, and professional education. These products and services are sold through various channels including brick-and-mortar retailers, online retailers, wholesalers, college bookstores, individual practitioners, corporations, distributor networks, and government agencies. In addition to these core businesses, John Wiley Sons, Inc. also provides data-driven insights and knowledge services that support the advancement of science, innovation, and learning worldwide. The company's products and services cater to a diverse range of customers including research libraries, library consortia, researchers, professional society members, business leaders, educators, students, and government agencies. Overall, John Wiley Sons, Inc.'s comprehensive portfolio of businesses and services makes it a leading provider of authoritative content, data-driven insights, and knowledge solutions globally. The stock price of John Wiley Sons, Inc. has dropped significantly in the past year due to several factors related to its earnings reports and financial performance. One major contributor was the Q2 fiscal year 2026 earnings report, where the company reported a revenue decrease of 1.1% compared to the same period last year, with its learning division experiencing an 11% drop. This led to a new 52-week low for the stock. Another significant event was the Q2 fiscal year 2025 earnings report, which saw shares drop 4.7% after the company reported a year-over-year revenue decline of 1.7%. The negative free cash flow of $99.9 million for the quarter raised concerns about profitability and operational efficiency. Despite periods of recovery, such as a surge in early March 2026, these reports had a lasting impact on the stock's performance. The combination of these factors has led to an overall yearly decline of approximately 19.78% in the company's stock price. The disappointing earnings reports and financial performance have raised concerns among investors about the company's ability to maintain its revenue growth and profitability. John Wiley Sons, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. John Wiley Sons, Inc. trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 2.58 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.79%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline in the company can be identified through an analysis of various segments and revenue streams. Revenue growth is primarily driven by research publishing, which has seen continued growth in author-funded open access and recurring revenue models. Additionally, AI license revenue has increased, contributing to overall revenue growth. The research solutions segment has also experienced growth due to AI license revenue. Overall research revenue has grown 4% on a constant currency basis. On the other hand, revenue decline is evident in several areas. Research solutions have seen softness in recruiting and databases, while licensing revenue, including AI, has decreased. Academic revenue has declined due to a decrease in print book sales and digital courseware and licensing revenue. Professional revenue has also declined due to a drop in print and digital sales through retail channels and licensing revenue. The company's revenue growth is largely driven by its research publishing segment, which has seen significant increases in author-funded open access and recurring revenue models. The AI license revenue has also contributed to the overall revenue growth. The net income and profit margins of the company underwent significant changes between 2025 and 2026. For the 3 months ended January 31, 2026, the net income increased by a staggering 433%, rising from -$22.9 million to $29.7 million. This improvement was largely driven by cost savings from restructuring and expense management, which led to an increase in adjusted EBITDA margin from 93.9% in 2025 to 105.4% in 2026. However, the 9-month period saw a different trend. The net income increased by 433%, rising from $16.1 million to $86.3 million. This growth was also attributed to cost savings and expense management, as well as a decrease in interest expense and net foreign exchange transaction losses. On the other hand, the adjusted EBITDA decreased by 6% due to lower revenue and higher cost of sales. The company's profit margins improved significantly due to various factors. The decrease in interest expense and net foreign exchange transaction losses contributed to the increase in net income. Additionally, lower operating and administrative expenses further boosted the profit margins. However, the growth was partially offset by a decline in revenue and an increase in cost of sales. Overall, the company's financial performance showed significant improvement between 2025 and 2026, driven by effective cost management and expense reduction strategies. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the extracted summary, the net cash provided by operating activities has been consistently high over the past 2 years. In 2026, the company generated $103,312 in net cash from operating activities, while in 2025 it was $52,250. These figures indicate a significant increase in operating cash flow, suggesting that the company's financial health is improving. The positive trend in operating cash flow is a crucial indicator of a company's ability to meet its financial obligations and invest in growth initiatives. It also suggests that the company's management team is effective in optimizing operations and managing costs. Overall, the data confirms that the company is generating positive operating cash flow, which is a key metric for evaluating a company's financial performance. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt has increased from $799,435 to $807,538, indicating a moderate rise of around $8,103. However, this increase is not uniform across all periods, as seen on page 4, where long-term debt decreased slightly from $789,435 to $796,288. On the other hand, interest expenses have shown a more pronounced decline. The data indicates that interest expenses have decreased by approximately $6,994 from $40,138 in 2025 to $33,144 in 2026. This reduction is consistent across multiple sources, including pages 7 and 45-46, which report similar decreases of around $7 million. The decrease in interest expense can be attributed to the decrease in total debt outstanding, as mentioned on page 38. The company's efforts to manage its debt have resulted in a lower interest burden, contributing to improved financial performance. Overall, while the company's debt level has increased slightly, the reduction in interest expenses is a positive development that suggests the company is making progress in managing its financial obligations. The financial performance of the company's segments varied significantly in January 31, 2026. On a positive note, non-US businesses shone brightly, generating substantial foreign currency translation gains of $33.3 million and $23.3 million. This indicates that these international operations are thriving and contributing positively to the company's overall financial health. On the other hand, print book sales return reserves were a major area of concern, with a net liability balance of $9.7 million. This suggests that the company is facing significant challenges in managing its print book sales returns, which may be impacting its bottom line. Overall, while some segments are performing well, others require attention and improvement to ensure the company's continued success. Management is outlining a comprehensive plan to drive growth and efficiency across the company. A key initiative is the Global Restructuring Program, aimed at achieving significant operating savings over multiple years. This program will enable investments in new technologies and products, as well as the integration of acquired operations. The company is also expanding its publishing program and journal portfolio to meet growing global demand for peer-reviewed research. Additionally, management is focused on maximizing value from subscription-based models and exploring content licensing opportunities. To ensure financial stability, a robust liquidity management strategy will be implemented, taking into account economic factors and tax considerations. Ultimately, the goal is to create long-term value for shareholders through the generation of free cash flow, while minimizing product development spending. This strategic approach positions the company for sustained growth and success in an increasingly competitive market. The company has made strategic moves to expand and refine its portfolio through acquisitions and divestitures. In terms of acquisitions, the company has invested in various businesses to complement and grow its existing operations. This approach is aimed at enhancing its market presence and increasing revenue streams. On the other hand, the company has also engaged in divestitures, which involve selling off non-core or underperforming assets. The most notable example is a $X million divested business, as mentioned in Note 3 on page 1. Additionally, certain businesses have been classified as held for sale until their sale date, indicating that they are no longer considered core operations and will be disposed of accordingly. The company has demonstrated a commitment to returning value to its shareholders through two key initiatives. Firstly, the company has paid dividends in both 2026 and 2025, indicating a consistent track record of rewarding investors with a share of profits. In addition to paying dividends, the company has also engaged in share buybacks, which have been explicitly mentioned as part of its funding activities. This strategy allows the company to reduce its outstanding share count, thereby increasing earnings per share for existing shareholders and potentially boosting the stock price. Concerns about inventory buildup and supply chain disruption have been raised in the recent financial reports. On page 28, it was noted that finished goods inventory increased, which could indicate potential stockpiling issues. However, on page 44, cost of sales excluding held for sale or sold segment decreased due to lower inventory costs, suggesting a more balanced approach. Despite these mixed signals, there are also indications of supply chain disruption. Page 42 mentions professional revenue decrease due to inventory reductions at an online retailer, implying that some companies may be struggling with inventory management. Additionally, page 50 shows lower print book sales and decline in digital courseware and licensing revenue, which could be related to supply chain issues. The overall trend is concerning, as inventories, net as of January 31, 2026, increased by $3,972 on page 56. This significant increase suggests that companies may be stockpiling inventory, potentially leading to future supply chain disruptions. That concludes the financial summary for John Wiley Sons Inc. Feel free to comment below, and I will be happy to answer them when possible.